Want to welcome everybody. I'm Jim Farish of jimsnotes.com. Last week when we were talking about just some of the nuances relative to trading, one of the things that came up obviously in the presentation was the fact that of managing your trades on a daily basis. And so what I'm going to go through tonight is really that, because it is part of managing your trading strategy, but we're going to kind of funnel it down even tighter into how do you manage the day-to-day volatility of the risk of and volatility and risk of the market. And it probably couldn't be a better time to really talk about this, because the last 6 to 8 weeks we've had a lot of consolidation and a lot of chop in the market. And I'm going to start by saying this, that when markets get choppy like they've been recently, it's okay not to trade. It's actually okay to go on vacation and get away from it, because the more you push or force things, the worse it will get sometimes, and then you create brain damage to the point that you can't repair it. And what I'm talking about right now is what we're going through right in here, putting a box around what's going on in the S&P, and that volatility is right now, it's a real volatility. And I'm going to put up a price-only chart just so I can get rid of some of the lines that I've got on here. And I hear people, and I was listening to a webinar earlier today, because like you, I have mentors in the business that I've known for years, and I like to see what they're still trading, people that I've learned from a long time ago. And it was interesting to me in that people are trying to swing trade these movements in the market. And if you're very precise and you're very good and very disciplined at your trading, you may be able to catch half of those swings. But if you're trying to catch more than half of those swings, has been very difficult to do because of the news-driven environment we're in. And secondly is that most people aren't that disciplined. We tend to be very emotional in these type of environments, and we don't realize that two rules that I've thrown out many, many times that I trade with in this environment. One is that when the market gets this wacky, is that we take half of a normal position. So in other words, if we normally traded $10,000, we'll trade $5,000. And we'll add to the position if it confirms and moves higher, but we'll cut our risk by cutting how much principal we put at risk into positions. And then the second thing we do is that we widen our stops, because we don't want to get caught in the whiplash of the market up and down. And now on the website, we use a lot of the same disciplines that we use in any market environment, which creates more stops. But because we're not an intraday service, I'm not out here trying to tell you what to do intraday relative to that. So what I'm going to cover tonight is that issue, is that how do you widen your stops? How do you manage the risk of this in market? How do you scalp trades? How do you take money where the market gives you money gracefully and exit without worrying about what you're going to miss out on in the future? You got to realize that the markets, when they get into choppy environments, become very unpredictable, where trending markets tend to have much more prediction to them, and they're much more appropriate for trading, especially for technical analysis. And if you go beyond into using momentum indicators and the markets get really choppy, and we're going to put some of that in here tonight, I'm going to come back and look at some of this. But when the markets get choppy, you tend to hurt yourself much more than you think you're going to. And that is where people get frustrated and people lose money, is because they tend to kind of cut off their nose to spite their face, because they're going to force trades. And I can't emphasize enough that using a wider stop creates greater risk if you don't manage it. So as we go through this, I'm going to put up a PowerPoint presentation tonight, because I want to keep on task as to what I need to cover. And then I'm going to come back to this chart that we're looking at here, and we're going to try to add some indicators onto the chart that I normally don't talk a lot about indicators, just because I find that people get confused by them and they think there are unwritten rules with them that there are not. But indicators are just that. They're just a confirmation signal. They're not anything defined within my strategy. They just confirm whether or not my thinking relative to the strategy is where it should be. So I'm going to quickly go through the PowerPoint, and then we're going to come back and we're going to look at a couple charts, and we're going to try to practice some of what we are doing right now relative to this market and how we can put some of this into motion on a forward-looking basis, because all of that really is key to me as to how we move forward. So let's go and look at this, and we'll go forward. So I'm going to reiterate some of the things that we've talked about on the last couple of webinars. One is develop a disciplined strategy. You got to start somewhere. Decide what you want and why you're trading. If you didn't hear last week's webinar, I'd encourage you to go back and find a copy of it and listen to it, because defining what you want is really the basis for why you put money at risk in the market. It's about lifestyle. It's not about who can collect the most marbles or who at the end of the year has the best rate of return. I want to have the best lifestyle. I want to be able to live in the house I want to live in, drive the cars, educate my kids, give to charity, do the things I want to do. That's why I invest money. It's not because I have an ego that I got to prove that I can trade in the market. It's irrelevant. I need to make money for the life that I want to live. Outside of that, trading to me is a high-risk endeavor, and unless you find a way to capture that and manage that risk, you put yourself in harm's way more than not. So decide which strategy works best for you. We subscribe to the KISS principle. Keep it so simple you can do it. And we'll talk a little bit about some of those, but put it into play, build a system, a strategy, start choosing a strategy for choosing the investments, which are scans, strategies for managing your investment and your portfolio, which is what we're going to really focus on tonight, and then a strategy for exiting your investments, which is what we'll focus on tonight as well. But managing your money and not the market. You cannot manage the market. A lot of people talk about market management. The market's going to do what the market will do. The market today opened down because of the vote in Greece yesterday, which rocked kind of a euro to open the euro on the open. It impacted some things around the globe, and that really set the precedence for the trading day in the first half hour. But when we looked at the end of the day, the markets actually closed higher. Small caps, mid caps had a great day today. But you've got to look at what that news is and the relevancy of that news. But those gaps or those pushes lower are the reason you got to widen stops and give the market room to react and then unreact, if that's such a phrase. But it's going to react, and then it will change course relative to what it truly believes. But understand the emotions are very high right now, and the markets are moving very erratically. Manage your money is what we focus on. I hate to even call it trading, because it's really about money management. It's about managing the money that you put at risk in the financial markets using entry points, exit points, which are stops, and targets on every position, and then managing them as you go forward. Find the tools that work best for you. We're going to talk about some of those tools that we use tonight, and I have some other stuff that's coming that you'll have more access to as we go along. But 4 components to managing your money: technical, fundamental, structural, and psychological. We did a whole webinar on this back in October, and I really believe that this is the crux of what we do or believe, which is that you have to manage your money through the process of technical analysis, fundamental analysis, structural analysis, and psychological analysis. And technical is just that. It's a statistical study and probability of trends and patterns and all the various things that go with that, momentum indicators, oscillators, all of the things that technical analysis incorporates. Fundamental analysis, which is the facts, numbers, and the accounting, which a lot of people have shied away from fundamentals. More and more, I hear people say I don't look at them. I think that's a mistake. I think the market is fundamentally driven in time. I do think that technicals will lead the fundamentals, and that fundamentals are lagging. But fundamentals are where the most money is made on the longer-term trends, because the fundamentals confirm the trends, and that's what keeps people in the market over a longer time frame. So historical data to form an opinion on the future is really what fundamentals are about. Technical analysis in its purest form probably is the same. We use historical patterns to create future probability. Very much it is, I've heard technical analysis defined as market mapping, And that's really what, in its purest form, it probably is. It's a map of what the market's doing and creating. The difference is we don't know what's going to happen on the right side of the chart, and only the market's fundamentals will actually bear that out over time. Structural is outside market events. Greece today was an outside market event. Russia, when it was, beating up on the Ukraine, which it still is, even though it's not in the headlines, was an outside market event. All of these things, China has been an outside market event of late. What Mr. Obama had to say last week relative to the State of the Union address is an outside market event. If any of what he said comes to fruition, it will have a deep impact on the market relative taxation of the wealthy, and redistribution of wealth has a tremendous impact on capitalism. And if you don't believe it, just go back any time in history where we've had tax increases. Jimmy Carter administration, you look at the market over that 4-year period. Look at the Nixon administration when we took off the gold standard, what it did to the financial markets. A lot of issues when you get political issues so those are structural outside market events that act on the market. And then psychological is the 4 inches between everybody's ears. That is what I call perception versus reality. Perception today was that Greece would impact the financial markets. The reality is that Greece doesn't add up to the financial capital and market economic impact of California alone. So it is impactful on Europe. It will have an emotional impact, a long-term impact on the IMF, but you got to take it for what it is. Reality will bear itself out. The human element is what we're seeing right now, which is the chop. We got at market tops, we get greed. At market bottoms, we get fear. It's the exact opposite of what it should be. The reality is that we basically, I think, have a flawed view of the markets many times, in that we think we can control the market, beat the market. I hear all kinds of phraseologies about the market. The market is inanimate. The market is a collective voting group. It's just like the vote in Greece was just a collection of everybody voting. We tally the votes, and the winners come out on top, the losers come out on bottom. And stocks are very much the same. They're a collective voting system of everybody who wants to own or sell stocks. And for the life of me, I don't get why we don't understand that when there's a buyer on one side of a stock, there has to be a seller, which means that half of the people trading a stock have diametrically opposed views, meaning that one thinks it's a bad stock and one thinks it's a good stock. And that should tell you right there that the market is neurotic, and it's made up of neurotic people that will emotionally act based on what they believe versus what the market will bear out over time. If you have insider trading information, then that's a whole different venue. But for the most people in the world, we don't have that. So follow the leader, capitalizing on sector trends, market psychology, investor psychology, and outside events. They drive the markets really on a day-to-day basis. So that's the brief overview of everything we've gotten to, so that I can cover really what we're going to talk about tonight, which is, education and practice is vital to strategy implementation. You cannot stop educating yourself. I started out earlier saying that I was on a webinar earlier today. I probably read on average just investment material alone, just different strategy focused material. I bet I spend 20 to 25 hours a week doing nothing but reading. I will digest anywhere from 2.5 to 3 books a week relative to data that's out there on habits, psychological, minds. I mean, all the things that we have to deal with for trading so that I can be a better trader. I want to be better at what I do so that I can improve my lifestyle. So you have to practice. People, I got an email tonight before I started from a gentleman I've known for a very long time, and sent me an email wanting to know why I had a stop at a certain place on a stock today and how I picked the stop. Well, I sent him a chart, said it was a support level that we defined for the chart, so we cheated it by 15 cents, so we posted our stop just below the support, 15 cents below it, because it got within 55 cents of the stop today, and then it reversed and went back up and ended positive on the day. But, the focus is that I see things and I do things because I've done them so much over the last 30 years that they're routine to me. They're things I do without thinking about it. It's sort of like driving a car. When the first time you drive a car, it's very difficult to drive a car, chew gum, and do anything else. You know, if you learned on a stick shift like I did, it was always push in the clutch, put it in gear, let the clutch out, you know, hold the steering wheel. You thought about every movement. Look in your mirrors, look here, look there. Most people now can text, talk on their phone, watch a map on their screen, and watch a video all at the same time and not pay attention to where they're going. And by the way, they probably eating a hamburger while they're doing it. And the worst thing I've ever seen is we can't text, but we can have a dog sitting on our lap while we're driving down the street. I'm not even going to get into all that. But the issue is that it's about practicing. It's getting good at what you do. And I've put down 4 things here. One is research, which we're not going to spend really any time on tonight, but the strategy for the investment process. That's last week's webinar. Go back, look at it. Technical, fundamental, or quantitative. There's only 3 ways to build strategies. Any permutation thereof, you can build however you like. But we're going to focus on the entry, the stop, and the target. Entry is start with the end in mind. What are you trying to achieve? Break it down. Look at what you're trying to get out of this. And what I mean by this is that when you pick an investment right here, what is the goal? I mean, what are we trying to do? In other words, when we build this research process, we are defining a goal. So if I'm going to buy, let's just say I want to buy GDX, which is the gold miners, and I want to buy it at $19 with a target of $21.50, and I want to make $1.50 on that trade, which is about a 7.5–8% ROI on the trade, and I want to hold it for what I'm going to call a micro term. Now, you're going to hear me use these terms tonight because you got to decide on your time horizon, and there's 4 of them. I've introduced a 4th one because I think that people forget that short-term trading is generally 13 weeks out or to 9 months. And that's how I learned short-term trading, was that you want to look at things 13 weeks out to 9 months. Intermediate term is 9 to 18 months, and then long-term is 18 plus months. Generally, you're looking out to as far as 36 months. If you can see that far, most people can't see further than a week. This is 0 to 13 weeks, which, believe it or not, is when people talk about trading, this is what they're talking about. When they talk about trading, we're talking about micro terms. When we talk about investing, this is what they talk about. So I'm trying to use terminology that a lot of people use. I don't necessarily agree with it, but we seem to want to brand everything, and I don't quite get why. But when I look at the micro term of the market, I want to know, what is my goal? If my goal on GDX, if I bought 1,000 shares at 19, then my goal is to make $2.50, or my goal was to make $2,500, and then that $2,500 may be my education tuition for my daughter who's at school, or it may be for my wife to go whatever. I'm sure if she's listening, that she's saying, yes, I'll take it. But focus on what you're trying to do with the money. So make sure that you defined the entry with the end in mind, and then define the strategy, whether it's relative to a breakout, a breakdown. What are you looking for your entry point? A breakthrough support, breakthrough a moving average, break below a moving average. What is going to set the trade up for you going forward? How do you get into the trade? Define it before you ever get down the road. So the research component of this, for me, when we talk about this, the research part of this right here defines all of these. So what you're looking for in your research component is, how am I going to get into a trade? How do I get out if it goes bad? And how do I collect my profit if I hit the target and move beyond it? So each of those has to be defined before you go forward. And we're going to spend a little bit of time going through each one of these pieces in what we're going to look at in a second. But start with the end in mind. Stops are risk management. You need to look at it that way. They're managing the risk that you're wrong. And I know that most of you think you would never be wrong, but if you can be wrong 50-50, and you can control your downside and let your profits run, you're still going to make money. You don't have to be right 100% of the time. And people who tell me they're right 100% of the time, I tend to go the other way. Even people that tell me they're right 90% of the time, I tend to walk the other way. If people are realistic, they may be 60-40, being right, being wrong, and that's over a 5-year period of time. I'm not talking about a 30-day window. Tell me what you've done over the last 5 years and how your trading strategies have been built. And I guarantee you, from my perspective and my historical beliefs and seeing and validation, is it's more like 60-40. Because in a 5-year period, you're going to get market corrections, you're going to get chops, you're going to get things that cause losses. And those losses add up if we don't use some disciplined way of controlling the downside risk. Now, so we want to use that. So we define it, the entry, we define it before we ever take the entry. So the risk of the trade is defined before the entry is taken. Profit management is just that. We always want to let our profits run as much as we can, but we want to know where the destination is before we leave the driveway. Before we buy the stock, where are we going? And, so that when we get there, now we can make an intelligent decision based on what the true objective of the issue was when we bought it. So practice is vital. The old adage, practice makes perfect, is very true. I don't know how many of you have ever played sports, but I played baseball all the way through college. And when I played baseball as a 6-year-old and when I played baseball as a 22-year-old, the fundamentals were the same. The hitting fundamentals were the same. You got to learn more advanced techniques like how the ball comes off the pitcher's hand, the spin on the rotation of the ball. Everything slowed down. The more you practiced, the more you looked, the more you did, the better you got at it. But it was still the fundamentals that determined whether or not you could hit a baseball, and it was the fundamentals that determined whether or not you could catch one, throw one, whatever. All of those fundamentals were there, and you had a coach who was always yelling, remember the fundamentals. Errors kill teams. We've seen it. In football, it's the same type of thing. Practice, drill, rehearse, and then you get on the field, it becomes second nature. The game slows down. Trading is the same way. The more you trade based on a discipline and based on a process and a strategy, the market slows down. It becomes much more visible. But when you're first a novice at this and you're looking at the markets, it's chaotic. You need it to slow down. The market needs to become slow to you in practice. It's like today when the market, I saw the open, we let it kind of sell out and then looked for whether or not it would bounce. As it bounced and it went back up, I kind of felt that the Greece news would ultimately be a non-event on the day. What was interesting to me today was small caps and mid cap moving higher and what that may mean to the market going forward. Those are the things that I look at. I look at, is there something going on? Instead of getting caught up in the nuances of a 5-minute chart or a 1-minute chart or a tick chart, I want to see what's going on. I want the market to slow down, and I want to be able to visualize what's going on in the market, and that's some of what we'll go through on setting up some of this stuff. So practice perfect. Paper trade, learn. The only thing I think about paper trading that's great is how to enter an order. How to use, buy stop limit orders, how to use buy stop orders, how to use sell limit orders, sell stop limits, how to use conditional trades, how to do things in a way that makes the market easier to manage. And paper trading, to me, gives you that practice without actually putting orders out there. You can see how your orders execute. You can see if they did execute. You can see how volume impacts those trades. But it's practicing paper trading is practicing the actual trade entry process to me. I don't think you learn anything about the markets paper trading because you have no risk. When you have no risk, you have no worry. And when you have no worry, we all do things right. When you've got real money on the line and you're excuse my crude analogy, but your sphincter tightens up a little bit because you're about to lose money and it's a real money, it's a lot different than you losing $500 on paper. Paper trading to me is where you should learn how to place orders, how to get in and out of the trade. Remember that we have the entry, the exit or stop, and the target. Practice those trades. Practice putting those trades in. And I know that sounds stupid, and I know sometimes some of you are going, oh, get on with it. I'll get on with it when people actually start entering trades correctly. Too many people don't know when to use a market order. They don't know when to use a limit order. They don't know when to use a stop limit order, and they don't know when to use an all or none order, and they don't know how to use conditional orders. And the reason they don't is they don't practice them. If you're going to trade options, you better practice trading options on a paper trading account before you jump in, especially if you're going to do multi-legged options where you've got straddles and collars and all these crazy names, condors, and I'm trying to figure out how an iron condor flies. How do we came up with options trading analogies is beyond me. But the point being that practice those trades, then implement your strategy, because then you implement it with smaller dollar sizes, which is the second part here is you practice investing. But practice with smaller dollar amounts. You want to practice with the smaller dollar amounts because it allows you to learn the emotions relative to the market's ups and downs. And it allows you to put a little bit more in, and then a little bit more in, and then a little bit more in until you work up to full-size positions that you're comfortable with. But practice them. Keep it simple until you remove the emotions from the trading process. At least 99% remove them. There are always going to be those times where things hiccup and go the wrong way that your emotions step in. I still get them every day. I get butterflies half the time when I'm looking at the market, which is why I don't like to look at it a whole lot. Practice your knowledge daily. Manage your exiting positions daily. Reevaluate the risk and profit of the outlook. Did anything change? If so, what? And what would I do now? And that's what we're going to talk about right now, is that this is an old trade, but I didn't want to pick a current trade because I think it confuses the process. But this is an old trade. So when we get into a trade, we have a position and we take on a position, we have to manage the position. This is just simply nothing more than taking a trading range, which you can see is set up right here. So this is a technical setup. So when we look at technical analysis, we know that when we're in a trading range, what we want is one of two things to happen, and I'm going to talk about this in a second, is we want it to break out so we can trade the breakout on a high probability in a trending market, or we want it to bounce off the low. So we want it to bounce off the bottom of the trading range. And so what we're looking at, if we look at this right here, you can see right in here, those four bars tested the bottom of the range, and then they moved higher. Some people choose that to be their entry in their strategy. Some people choose this to be their entry in their strategy. Is one right, one better? Statistical probability in an uptrending market, the breakout is more predictive than the bounce off the low. If it's a choppy market, you can at least scalp the trade for the height of the range or some portion of the range. So it's really a difference of what you want to do. In this particular setup, what we are looking at is that we look at in a trending market, which you can't see all the way here, but you can see it coming into the box. This was an uptrend. So in a trending market, higher probability of the trade is on the breakout. So we're going to take the breakout. So we set the trade up for the entry. Remember that the strategy says that the strategy defines the entry. So the strategy is a trading range breakout, and we're looking for it to break above the top end of the range. And so you can choose. You can choose that I'm going to take it a penny over the breakout. You can say I'm going to take it at 1% over the breakout. I'm going to take it at $1 over the breakout. You define that strategy. For us, we define it as about 0.2% approximately. It's not always written in stone, but we're going to look at roughly 0.2% on the breakout as the entry point. So we've defined the entry. How are we going to buy it? We're going to buy it, and we're going to say we're going to round this off to 1,000 as the breakout, just for argument's sake. This is the S&P 500. But so we're going to say we're going to buy it at 1,000. And we use dollars instead of the index number just so we can walk through this analogy. So we're going to buy it at 1,000. So when we've got to now decide, who am I? And what do I mean by this? We fail to ask ourselves important questions. We ask ourselves trading questions, but we don't ask ourselves psychological questions. Who am I? What kind of trader am I? Am I a raging neurotic? Am I new at this? Do I feel uncomfortable with this? Do I not trust myself? Do I let it run too far? Do I tend to bail out at the wrong time? Then you need to go back and practice auto entry. And what I mean by auto entry is that I'm going to come in and I'm going to put in a buy order on this at 1,000. Now, if the volume on the S&P is high enough, I don't really have to worry about the limit side of this, because generally I'm going to get fairly close to my execution because the high volume keeps the spread at a limited risk of a gap. Whereas if I have a lower volume trading asset, then I want to use a limit order. But if I use a buy stop, so when it hits 1,000, I may get executed at 1,005 cents. So the stop is enacted by it hitting the $1,000 level, and I own it at 1,005. If you only want it at 1,000, then you put in the buy stop limit, and the limit order can also have all or none, meaning that if I wanted to buy 100 shares, I want all 100 shares at a limit price of 1,000 that will hit the entry price at 1,000, and it will only buy if it stays there. So understand your order process going into the entry of the trade. So defining the entry before you get to the entry, not at the moment of emotion, but before you get there. The worst thing that can happen is the S&P hits 1,000 and you're trying to enter the order. Have the order entered. We enter all orders before the market opens. Generally, between 9:15 and 9:30, I'm going to enter my orders. If we've got a gap on the futures, I'm not going to enter my orders. And everybody understand what I'm talking about is that a gap is that if we closed here at 1,000 and the market based on the futures is going to open at 1,100, I'm not going to put in an order because it's not going to get executed. It's going to gap above it. If it's gapping below it, I'm not going to put in an order because it may spike up and put me into the position and turn and go back down. So gaps negate putting the order in before the market. If the market's in an orderly fashion coming into the open, we'll place the orders. So use each of those little tools there on the entry based on how you want to get into the trade. So once we own the trade, so we buy this, we own this at 1,000 here, the next step becomes the stop. Now, if this trade goes off, this trade is put in. Not tomorrow, not next week, not 12 hours from now. It's put in now. So we go in and the initial stop based on the strategy. The strategy was a trading range breakout. A violation of that pattern, which would be a break back below the low end of the trading range, so it can come back into the trading range. It can't break below the trading range. So my stop is going to be over here at 965, or I've got a 3.5% downside risk to the trade, or I got 35 points. So my stop is defined by the strategy. It's entered, and I'm in the trade. My target is based on the height of the trading range, which you can see here. The height of that range is 965 to 1,005 roughly, which means that I've got 40 points on the upside that I'm looking for, that I'm going to put my target right here. So there's the target of the trade. So I define the entry, I define the exit or the stop, and I define where I'm going, the destination. And to me, there's one thing that does psychologically. It gives you confidence that the worst case scenario is you're going to get stopped out at 965. Best case is it's going to go higher. And then we're going to hit the target, and then we're going to decide at that point what we do. So now let's break down all three parts of this and go through them. So what we want to look at is the entry. So all I did was break this chart into three parts. The entry point, which was defined by the pattern. So we're going to take it on the breakout. So we're looking at a bottom entry or a breakout entry. And I defined them both here. So you got one or the other that you can take. And so you decide, do I want to take this entry? Whoop. Do I want to take this entry down here at the bottom, this one? Or do I want to take this one? Either entry has some probability of risk to it. Here's the challenge. If you take this entry off of this bottom test and let's say you enter right in here, where's your stop go? Your stop may be the break of the range right here, which we said was 965. But if this entry is at 980, that's a very tight stop. So you may want to look at the previous low on the close, which was back down here, as your stop, which may have been 940 or some, but you're going to give it some room. So your stop gets adjusted relative to how you get into the trade and the discipline that you're using to get into the trade. People think there's a magic to stop manage or setting stops. There is no magic. There's a moving average, there's support, and a previous low, a trailing stop, which is a percent of the trade that you maximum loss that you're willing to say 2.5% or 5%, but you trail the stop based on a percent. I set my stops on the entries based on the chart because these are technical entries. For me to arbitrarily say I want to set my stop on the 50-day moving average, I'm not using the 50-day moving average anywhere in this strategy to define the entry. I'm using technical analysis to define the entry. So I want to use technical analysis or the chart itself to define the exit point. So I'm either going to use, if I buy the breakout number 1 up here, then my stop is here. If I use point number 2, which is the bottom reversal within the range, then I'm going to have my stop at the previous low below the range, which means I'm going to give it room to break out and come back into the range. And if I have my stops too tight, I'm going to get stopped out, comes back into the range and breaks higher. Then we go, oh, crap, look what I did. Learn from your mistakes. How I got to these little simple tools that are rules and guidelines that I use is by learning. It's by writing it down, keeping a journal. What did I do on trading ranges that didn't work well? What did I do on trading ranges that did work well? What was the trading environment when I traded in the range? Was it a choppy market? Was I coming out of a previous uptrend? Was it a downtrend into a trading range and I was looking for a trend reversal? Look at what got you in and out of those trades. Keep a journal, and you'll become much more proficient at your entry and stop points because they're defining how you get in and out of the positions. For me, that should be kind of routine. In other words, what I mean by that is that you're looking at a trading range becomes routine. Triangle breakouts, whether symmetrical or wedges, they become routines. If I'm looking at downtrending wedges, uptrending wedges, bull, bear, emphasis, what I'm looking at, all of those things get defined by trading them, practicing to where it becomes second nature. And, I have to step back a lot of times and remember that one of the biggest reasons I get questions about where I set stops is people haven't practiced using them. We just think there's some magic to them. There is no magic. The magic is learning how to trade within you, within your discipline, within your strategy, so that the stops make sense to who? You. My stops make complete sense to me. Now, here's the big bugaboo in the house, is that how do you manage the stops in between the entry and the exit point? If you raise your stop too fast, you'll get chopped out of the market. If you raise them too slow, you'll give up too much profit. And that depends on the angle of ascent. In other words, when we covered this in a webinar want to say last September timeline. We did two webinars on trends. And this is the trend. And that trend is roughly a 45-degree angle. In that trend, I'm going to give more room to my stops as I ladder them, because if the trend is 45 or less degrees, then the market is moving methodically. It's not out there willy-nilly going crazy. But the greater the ascent of that angle of the trend, then to me, the tighter the stops become, because the greater the fall. The more climax the market runs, in other words, the steeper the pitch of the trend, then there's a greater chance or probability that the market will fall faster, and I want tighter stops, especially if I'm trading or on a micro-term basis and I'm looking at short-term events. Now I want to look at something that's happening right now with GDX. And I own this position, so I understand what's happening, real time. And that with GDX, regardless of how we got in it, look at the angle of ascent. It's very steep. And you can see that this came back to 21 and some change today, and it was just at 23 and 25 cents. So that swing downside off of that, you can see, to me, was fairly substantial, in that what you had from peak to trough was almost a 9% swing on that. That's because of the angle of ascent. Now, if I'm in this as a micro-term trade, then I want my stop probably up here at 22.15, and I got dinged out of that stop either here or on this bar. One of those two bars would have taken me out of the trade. And you can see now it's rallied back to 22.15, but it hasn't eclipsed that. Now, if it does, and it eclipses back into a range where I want to own the stock again, buy it back. There's no rules that says you cannot buy these things back. There's only our rules. We're the one who makes the rules, not anybody else, and we're the ones who trade them on a day-to-day basis, so they got to trade within our own willingness to take on that risk. So when you manage stops, you're managing what's happening now. And that's really the vital component of this, is that you want to manage what's going on right now. And if we look at, I wanted to stay on that chart for a second because I want to look at this, because I want to inject a couple of things. And that, let's go back to an intraday chart of today. What happened? I mean, GDX gaps lower at the open. Well, the first place I'm going to look is gold. Well, gold gap lower, so it would make sense that GDX would gap lower. Now, the divergence is that GDX actually went back up on the day when gold did not. Gold actually closed lower on the day, and the question begs, why did the miners go back up? And I don't have really a good answer for that, other than that the buyers were willing to put money into GDX on the belief that gold wasn't going to go down all that much, and that's all there really was to it. But you want to look at the bigger picture of what's driving things. In other words, what's happening in gold, not only in the United States, but internationally. Is there inflation? Are there things out there? And I think you saw that the miners moved up in Europe today because the euro has moved down. Inflation is on the horizon. If the ECB continues to flood money into there, you've got all kinds of fundamental rationale behind why gold would go higher, and the miners generally are going to trade in advance of the gold. So know why you own it and what's driving that component. Know why you're in the trade, and then look at the story around the trade. Remember, outside market events impact the market. The question I had today is that if Greece is going to impact Europe, then why did IEV actually go up 1.5% today? I think that the bottom reason of that is that money flow is going to increase into European stocks because of the stimulus. All you have to do is go back and look at the U.S. markets. Go back to November of 2012. Let's look at this real quick. When stimulus was enacted in the U.S. markets, and let's look at find a weekly chart here where we can go back. Here's the bottom right here for the November of 2012. When you inject stimulus into the market, That's what the U.S. markets did. And we're injecting the very same type of stimulus into the European markets that we injected into the U.S. markets, which is quantitative easing, which is buying bonds back out of the market to control interest rates so that inflation stays at bay while the economy ticks back up. That's what that's all about. So what we're looking at realistically is we're looking at what could happen in Europe on a relative basis to what happened in the U.S. So I like what we see. I like the whole opportunity that Europe offers, and I think you got to look longer term. But today, that environment traded higher off of the lows, and you can see what's starting to happen on the weekly chart is we're now getting to the point we're going to break out this longer-term trend off of this high, going back to the June timeline that Europe's been correcting. And if it can get above this 44.90 level on IEV, I think you could see Europe actually start to resume this previous uptrend that's back here. So that's, again, current market, and how all of this applies back into the current market is that we're always want to apply what we're learning to what we're doing and practice it. Look at it. If IEV is trading at $45 a share, if I go and buy 100 shares and I want to manage those shares for, let's say, an intermediate time horizon of 9 to 18 months, so I'm looking out intermediate term, now I want to manage that based on that. So time frame matters, strategy matters, and what's happening in and around the market matters. And how you manage your stop relative to that matters. Because once I get in the position, I want to manage that rise of the position. And this goes back to this issue in that here is the initial trend. And I have some questions here, which I'll come back to if you'll give me time. But we accelerate. When the market accelerates, we want to accelerate our stops. So we want to ladder our stops up, and then we want to give them room to test. You can see here's the stop. It comes down and it tests, and it goes back up. And I chopped it off, but what you're going to see is it comes back and it takes us out of that position. But the management of stops is multi-tiered. So one, we're going to look at the trend. So if the trend's accelerating, our stop should accelerate. All right? It should accelerate with it. Secondly, is we're going to look at support. In other words, we're in an uptrend here, so we're not short the market. If we're short the market, we would look at resistance. But we're going to look at support and where those support levels establish themselves. And then when we're in gradual trends, that's where I'm going to go to. I'm going to go to support. And support is the previous test. So each of these tests that you can see down here, that those tests become support and they become the stop. So if the trend is gradual, we're going to use support. If the trend accelerates, we're going to generally default to a moving average, worst case scenario. And in this case, the green line could be your default, or the blue line could be your default relative to the moving average. You pick based on the risk you're willing to take based on the story now. And what is intriguing to me is that we want to set a stop blindly, not understanding what the story is now. The story now is important to me because the story is either defining the acceleration and justifying it, or the story is diverging from the acceleration. Remember, the story of the market can be completely different than the trend of the market. Eventually, fundamentals catch up with the market. That's the story. Eventually, it'll catch up. But right now, it's not going to catch up because we're trading on emotions, and therefore, the trend accelerates. Accelerate your stop. The trend is gradual. Trail your stop with either support lines, moving averages, but give yourself room to stay in the trade. Don't try to get out of the trade for the sake of getting out of it. Get out of the trade when the market tells you the trade is done. So manage your positions, raise your stops by daily deciding what's going on. So the third piece of this to me is the story. And the market tells a story every day. And that story today was a little bit different than it was Friday. And we have to let those things acclimate to how we manage relative to where the market is currently. So take what the trend is, take the support, take the story. When this accelerates, I mean, the dollar, if you looked at the U.S. dollar, the acceleration of the U.S. dollar has been very steep relative to what's happening with the euro, which was happening to the yen, which was happening to the ruble, which was happening. You know, the basket, the dollar index, DXY, the ascent on that has been less than UUP because UUP benchmarks the dollar. Whereas, and how it accelerates against specific currency, where the dollar basket, the index, is taking 11 currencies and measuring them. So you got to look at what your benchmark is, understand your timeline, and then manage the risk accordingly. So use trend line analysis, use support analysis, use technical analysis, and ask yourself this question. If today I bought on a double bottom breakout right here, my stop would be right here. Is that risk what I accept today? If it is, you leave your stop there. If the story of the market is that short-term, you know, there's noise about XYZ and ABC and EFG, does that story, one, is it going to have a temporary impact on the market? And this goes back to other webinars that we've talked about. News can be temporary or sustainable. Is it a temporary news or is it a sustainable event? If it's temporary news, I'm sticking with my stop and we'll see how it plays out. If it's a sustainable event, I'm probably going to raise my stop and let the market take me out sooner because I don't like how it's setting up from a sustainability of the downside risk of the market. So every day when I wake up, I'm asking myself a series of questions. When the market closes at 4 o'clock on Monday afternoon, and tomorrow morning at 4 a.m. when I get up and I start looking at what happened overseas, I look at what happened to the U.S. markets, my perspective at 4 a.m. is different than my perspective was at 4 p.m. because I have more information. And now I'm going to sit back. The markets aren't open. They're closed. I'm going to sit back and I'm going to evaluate and I'm going to study the risk of the market today. And I'm going to say, what do I do today? And I'm going to go back. I want to go back to this and look at today's market. Let's go back to the price chart. And let's put up the S&P 500. And let's look back at this from today. Now, I'm going to put a horizontal line right in here. I'm going to put another one right in here, and another one right in here. And I can make arguments for all three of those being entry points off of this bottom reversal. And I'm not going to do that because it's irrelevant, but any one of those three could be an entry point. If I took this entry point and I'm up here and I'm testing back, the question is, where's my stop? Well, the stop at this point for me would be at break even. So if I were looking at this, that this is where I got in 2013, 75, that's where my stop is right now. So it's a break even trade. And you say, well, why wouldn't it be up here? It's too tight. There's too much news in the market. There's too much uncertainty. I've got Greece. I got China. I got all these international issues going on. I got earnings out that have been pathetic, by the way. I've got economic data on the table. I've got consumer confidence. I got housing numbers that stunk last week. I got terrible housing data out for 2014. I got all kinds of things that are working against the market psychologically. So if I put a stop up at 2040, I might as well just sell it at 2060 and take my profit and move on from the trade. And if that's what you want to do because you don't like the risk, you do have that prerogative. Because remember, the target on this trade would have been up here to retrace back to the previous high. So the stop, the entry and the stop now are the same, but the target's up here. I haven't hit the target, but I can always choose. If the risk of the market is against me, I can lock in my profit and go on down the road. That's your prerogative as a trader. Just don't cry when it goes higher. Don't look back and go, I made a bad trade. No, you made a trade based on the knowledge you had at the time you made it. That's why you keep a journal. That's why you write notes. Why did I take the exit? Is it justifiable? Would I have changed anything based on what I knew at the time? If the answer is no, quit whining. Take responsibility for your trades and quit whining. If you make money, be grateful. If you lose money, understand why and fix it. If you can't fix it, and that was just the way it happened, quit whining. Move on to the next trade. Whiners don't make good traders. And people who think they have to be perfect every time stink at trading. They stink at it because eventually the market's going to kick you right in the seat of the pants and knock you out. So focus on what you're doing. The stop is, how I got into the trade, and where I got into the trade determines the stop. Let and give it room. So if I got in here at 2060, my stop's down here at 2015. So I'm going the opposite way. I still have a loss if it goes back below that level. But that's the choice you make. Use the parameters of the market. I still think that two things happened today, which is why I wouldn't change any of my stops going into tomorrow. One is RUT. The Russell was up 1% today. The Russell broke above 1190 resistance. It's put itself in a position to go to 1220. How the Russell acts from here going forward, I think, is going to be a leading indicator for the broader market indexes like the S&P 500 and the NASDAQ. The second component that happened today is the mid-cap stocks actually came within 3 points of hitting their previous high up here. They're trading within this beautiful trading range. Mid-caps, by the way, have been more of a leader than small caps. And you can see that this is set up as a perfect A, B, C, D pattern off of a ascending trading range. You could have traded off of the D in here with an entry at 1430. You're in the trade today at 1470, and I would be laddering my stop up somewhere in here around the 1442 level, and I would be looking for that to break and confirm above that resistance level as a leadership of the market, and at some point create an E point on that uptrending channel. But because of what small caps and mid caps did today, I think that the market has a fighting chance of moving higher off of its current levels despite the test that it got early in the trading day. Now, that can completely reverse tomorrow, but that's my belief tonight at whatever time it is, 6:25, and that's my belief probably going into tomorrow's trading day, and I will set up my stops according to that belief. So I'll adjust where I need to adjust. I'll stick with where I need to stick. And I've already looked at the S&P. I wouldn't change my trade on the SPY. I wouldn't change my stops on the Qs, which I own. And I would kind of just move along here. My mid-cap stop, I would probably leave where it was on Friday, maybe cheat it up a couple of pennies. But I like where we are. MDY actually broke above a resistance point today right in here at 264.40 and had a nice follow through on the day. Look for tomorrow for that to continue to the upside. IWM, which is the small caps, you can see it broke above that resistance pain there at 118.50, closing at 119.26. I think it's still got a shot at that 121.10 high on the close. I like the trade on small caps based on how it's setting up. But those are all what I believe today. Tomorrow, I'm going to step back and look at my trades again and ask the question, did the story change? Now, understand, all of those are micro-term trades. In other words, those are 0 to 13-week trades. What if I'm in the SPY for a longer-term trade? I got to look at the weekly charts, and I've got to look at the weekly trends, and I've got to say, where do I get out? And right now, my trailing stop on this is actually that kind of peach-colored line there, which is actually red. I faded it so I could see less of it. But that's 195.50. That's where my stop is on the S&P on short-term trades, which are 3 to 9 months out, which are some positions I still have open right now. So I'm at 119.50, but on microterm, my stops are a little bit higher, around 202.50, 202.25. But you've got to look at the timeline and deal with the stop on a relative basis. Now, let me go back and move beyond this to the target, because the target is what you have to manage. You know, you want to let your profits run, but manage the forward risk of the trade. If this trade that we're looking at and that we're breaking down here, if I go to the next chart here, this is where we are out here on the chart. And reason that the stop's getting tighter, look at what the market's doing. The market will create, even on longer term trades, it creates micro-term patterns that if they default, which you can see here, it did, I want out. I want out of the trade right in here. I gave it room to break the 50-day, and I gave it room to violate that pattern, and it took me out of the trade right there. And then you can see it went down, it reversed, and went down again, and it actually tested that level, and then we all know that it went much higher than that because that's a 2004 chart. But you can always get back in. If it eclipses this old high, I would have an entry trade out here if I wanted back into that trade. But the original target is what I want to go back to on this trade by flipping down here to the bigger chart. Remember, the target was at 1,045. So what we were looking at in here was this being our target. Why would we let it run beyond there? Well, let's clean that up a little bit, and let's come back and draw on the chart again. Because what's set up here? Look at what was happening right here. You have an ascending wedge and a bullish trend. When you get an ascending wedge and a bullish trend, they tend to break higher. So I could have added to my position, but I definitely didn't want to stop out of my position unless it violated this stop over here, because that would have broken that short-term pattern setup and would have negated some of the trend. Therefore, it's going to take me out. I'm always looking for ways to get out of trades. Once I hit my target, I'm looking for how to get out of it, not stay in it. If I can stay in it because the market validates I should stay in it, then stay in it. But when I hit my target, I'm looking to collect my profit. I'm not looking to be a pig. Pigs get fat, hogs get slaughtered, and more traders go to slaughter than ever get fat, because we get greedy because we think that we understand all this. The market is only recording on a day-to-day basis what everybody believes. And what everybody believes at this point is that the market was consolidating to go higher. It validated. Here it was consolidating to go lower. It validated. Here it consolidated and it broke below that on a microterm basis, and it came back, and we could see the further chart. We'd see how it all panned out. But eventually, that big consolidation right there was a creation of this, and it created another breakout to the upside, giving you another trading opportunity. So you're managing every day how you're going to get into a trade, how you're going to get out of a trade, and how you're going to stay in the trade to ultimately get out of the trade. So each step of the way is nothing more than a confirmation of the trend. It's a confirmation of the time horizon that we're looking at. It's a confirmation of the risk of the market now. I'm going to say this slowly because it's probably one of my biggest pet peeves, is that when the market is up here at the top on this chart, when the market's up here in this environment, and we own this trade and we're up 10% on the trade, my question is, why are we willing to gamble with this money when if we bought it here, our risk was 3%? Why are we willing to risk our profit when we weren't willing to risk our principal? And on the other side of that trade, I've been doing this professionally for over almost 31 years. When a client looks at their portfolio, they have what I call high water syndrome. And so the high water syndrome is that we benchmark it to the highest point, and if it goes below that and we sell it here, they lost money. Even though they invested over here and they got out over here, they lost money because they want the high water mark. Understand, you're never going to get the high water mark. You're never going to get all the trade. You're never going to be perfect. If anything, trading, investing your money is like life. Some days you win, some days you lose. All you're looking for is if I can capture 60% of the move. If I can capture 60% of that move on the 50% of the times that I'm right, I'm going to have plenty of money. If I can limit my losses when I'm wrong so that I only experience a small percentage of the loss, maybe 3 to 7% of that loss offset, you can see how it works. But what we get into is we want perfect strategies. We want perfect systems. We want to win every time. We want to manage our stop perfectly. We want to manage everything perfectly. You can't do that, which is why I study habits so much, and which is why I study human psychology so much, is because we're trading against our nature. We're trading against who we are as a person. And the point for me is to allow yourself time, time to see where things are going, and time to let things develop so that you can trade according to practice, research, entry, stops, and targets. I mean, they're all vital to every step of the way. And so when you look at the market and you look at charts, what I would like for you to do is understand, the trend analysis is very vital to me, and I'm gonna try to answer some of these questions. I get a lot of questions about trend analysis because people, trend analysis was the first real evolution of technical analysis. I mean, trend analysis was where technical analysis started. And so to me, that's where you need to live, is within the trend of the market. And I'm just going to go back to a daily chart. And if you look at the S&P 500, to me, that's a very symmetrical trend line. And you want to be able to look at that from a standpoint that I like some symmetry in the market, because symmetry works best. And if we said, all of us have hopefully took some geometry somewhere along in life, and you have the x-axis and the y-axis, and if you look at that and you drew a 45-degree angle in there, it would be very easy to see that the S&P has followed that. And we could draw another trend line where it's been slower. We could draw another trend line where it's been more accelerated. But the point is that what we're looking at is a long-term chart. Where we all get discombobulated is in here when the market gets choppy, because that is no longer a 45-degree angle any way you cut it. That is a very aggressive pitch to the trend. So if you're shorting, we're used to aggressive pitches. If we're long, we're not quite so used to them, and we get a little bit more greedy on them. But we have to manage them just as aggressively regardless of what you're looking at. And if you're trading Forex, I'll have a Forex chart to put up here, but just looking at UUP as an example for the dollar, then I think you have to step back and ask yourself within this, here's the initial trend. Here's the acceleration of the trend. When trends accelerate, they tend to correct. And then it accelerates again, and it corrects, and then it accelerates again, and we got a minor correction, but now it's gone vertical on the dollar. So the steeper that line gets into that trend, you want to manage the risk of that trade more and more aggressively, especially on the dollar if you're long the dollar right now. And I think it's EUO is short the euro, 2 times short the euro. But you've got the same thing here, because as the dollar has gone up, the euro's gone down, and you can see what's happened within the euro relative to that. But we saw the same thing with the yen on the downside, which you can see the acceleration of the yen. It tries to correct, and then look, it goes, so now it's consolidating, and which means that the yen's either going to find a way to move higher, or it's going to consolidate and just move sideways like it did back in here. But when you're trading currency, it's a lot faster. The same as with when you trade precious metals. If you look at gold, it's going to accelerate faster because there's too much speculation in the commodities. There's too much speculation in currency. Whereas if you're trading SPY, it's 500 stocks. And it's large cap stocks to boot. So moving them takes generally some type of big event or news that is sustainable or believable enough that it's going to move the markets faster. Whether that news is bad news on the downside or good news on the upside, it's going to be there. So measure what the story is. It does matter. If we go back to the chart on the S&P relative to the targets on what we were looking at within the presentation itself, for me, the target on this is on a trading range. When you have a trading range, the target on technical analysis is the height of the range. So all we would do is take that height, lay it on the entry. So if the entry's here, we're just going to lay it on top of there, or we could actually stretch that across and measure it so that we could see exactly how many points that is, and then we add those 45 or whatever points on top of that so that we can measure the target. And then when the target's in place, let's go back to that as an example. If this is the target, once the target is put in place, what's coincidental in here is that that's where it set up the wedge and it broke higher. So why would I sell at my target? Now you can make a choice. You can say, well, if it broke back below this, I would take half off and I would leave my stop down here. I mean, you can always ladder out and ladder into position. That's part of what you want to decide as to how you manage your target. How are you going to be in or out of the position relative to what you're trying to do and where it is? So you're constantly moving the benchmark forward with where we are in the market. And that's why, losing my voice here, these points are over here. Entry, target, stop loss, trailing stop, exits, size, and manage the emotions. And here, you're managing two emotional impacts here. One is yours, and two is the market. And remember, the market is a bunch of raging neurotics just like you and me. And so we have our beliefs, they have their beliefs, and collectively the market will react to those emotions as they're enacted based on a 0 to 13-week time frame. Once you get past 13 weeks, the market generally will trade off of fundamental data, assuming that fundamentals are clear. We're heading into a 13-week consolidation period on the S&P 500 right now, and we still lack clarity, meaning that we may see an elongated consolidation phase of the S&P right now unless we can find some clarity in the market, and I don't see where we're at right now relative to that. One of the other questions is, are your trades strictly technical? No, fundamentals play into a lot of this. It's just easy to talk about in this format how to use technical analysis to set stops. But if I'm in fundamentally, let's just use as an example, I'm going to use a trade that we have on right now, which is Whole Food Markets. And I like Whole Foods, and I like them as a stock. Not a big fan of shopping there because we don't have one. But you can see this trading range was developing for Whole Foods, and then it broke out. Well, it gapped out on earnings. And one thing that when this happens in a gap on earnings, and earnings are that good, then you've got to go back and read the fundamentals. And this was a fundamental play. We were looking at this. Fundamentally, we know that Whole Foods shuttered over 200 stores. Fundamentally, they cut out all the fat. They did a lot of things to clean up their balance sheet. They shifted how they were marketing their stores. They shifted where they were putting their stores. They shifted what products they were selling. They went back to their roots, and they revamped their stores. It took them about a year and a half to do it. And now they're online to open 80 stores this year. All the things are fundamentally there for Whole Foods. What got me to Whole Foods was Kruger, which is KR. If you go back and look at that, Kruger's had a great run. But that's what got me to that, was that Kruger was doing exceptionally well in the grocery store business, and they were doing well for a reason. And so we went back and compared the fundamentals of Kruger to Whole Foods and said, how do we get into this trade, and how do we manage this trade coming out of the trade? Now, here's what a lot of people will do. When this market gapped open on the earnings, what do? We don't buy it. You've got to buy it. If your discipline was to say, I want in, then you got to pick where your poison is to get in. So you got to scroll the chart back and look at this. You can see the gaps higher, what it did last time off of this movement in the news. But you can see we used these 2 points over way back here in 2013, which came across at 46.30. That defined the entry. So the entry was at 46.30. This is an 18-plus month time horizon. It's a long-term investment. I'm looking out 18 months. I want into the stock. I got in and defined the entry. It's fundamental. My stop would be if it violated this gap right here at 43.35. And even then, I'm not sure how I would treat that. I'd have to see what the news was, why it went there, what was driving it. But we'll just say for now that that's where the stop is on the entry. And you can see it just meanders along. And then it sets up this little saucer right in here, and then it broke above it on like a cup and a handle breakout. We actually added to this position right in here around 49.50, and we still own it now. And we continue to go along with it. But because this is a long-term position, I have to be willing to hedge this position. Remember that if I'm looking long-term, I have to hedge based on the risk that the market presents. And right now, I don't see any risk. If I saw risk, I would buy puts against my position. I may sell half of my position, but I'm going to manage the risk of that position based on still the long-term horizon, but what's happening in the short-term events as to whether or not I want to add, take away. What do I want to do? Do I want to buy calls here to leverage up my position? I'm going to manage that position relative to what the market's telling me, but I'm in it fundamentally, and I'm going to manage it technically. That's as simple as I can make it. You want to use and understand your strategy. My strategies are unique to me. They work for me, and they follow along with what I do on a day-to-day basis. I think that we all have to remember that at the end of the day, it comes back to what I want to do and what I want to trade. Not me being I, but you. How are you going to trade this? If you don't respect the risk of trading, eventually it's going to bite you right in the butt, and it's not going to feel good. So always look out as to what your time horizon is, what are the trend lines doing. All of those play into how you manage stops and how you manage targets. So I'm managing them day to day based on that bumper that's moving back and forth. So nothing works all the time. There's no sure thing. I'm in this for the long haul. I'm a trader/investor for the long term. But in reality, I'm a money manager. I manage my money in light of what the market is doing every day. I'm going to take my time horizons, and I'm still going to come back to what is the market story today. Is it sustainable or is it temporary? I'm going to look at what the events are around the market, the fundamentals around the market. And by the way, earnings stink. This whole PE ratio fundamental of the S&P vernacular, I think the market's getting expensive. I think it's going to struggle if we don't find some relative catalyst that makes sense to this market on a fundamental basis. And right now I don't see that. We got the FOMC meeting starting this week. That's going to get interesting relative to the Fed's projections, but a lot of things on the horizon there. Define your trading strategy. to me, it's really about the discipline of doing. It's practicing, getting better at it every day. Keep track of your trades with beginning to end. Have a plan and a strat. Your plan is your strategy, but I have a trading plan every day that impacts every position I own, every position I manage for clients, every position we have on the website. We manage those positions and have a plan for them every day. And the strategy is built on what we just talked about. I look for feedback, which are daily adjustments. The feedback is the chart. What did the bar do today? What happened in the news today? What happened fundamentally today? We're going to get economic data out tomorrow, which I think is important data that comes out tomorrow. So, I mean, that's going to play into tomorrow. Earnings are going to play into tomorrow. The scorecard, my journal review, how did you do? Did I do good? Did I not do good? How did I handle the trades? How did I handle the emotions of trading along the way? Now, I'm going to make this offer because I get constant request for people wanting to learn how to trade. And I'm not a coach. I'm a teacher at heart. I'm not a coach. I don't want to sit over your shoulder. I don't want to tell you how to do things. It's just not how I function. But, I've been batting this around. I was going to do this in March, but I'm going to offer it now because we're coming to the end of January. We're in an interesting period of the market that there's a lot of things that validate and work. We did a series last spring on Back to the Basics of trading camp for investors. And there are 4 components of that. We've talked about those over and over again. Even tonight, we've talked about 3 of those 4 components. And what I want to do is find out if people really want to learn how to trade. So for the month of February, I'm going to have a little trading camp with Jim's pattern trading model. And if you don't track the pattern trading model, I'm going to pull this over. This is the spreadsheet that I use for it. It's not on the website, but these are the open trades that we currently have within it. And I track those trades. We track the historical trades, all of them, going back. We've actually been charting this for, I think, started September 1st of 2014, or 13, I mean. So it's a year and 4 or 5 months that we've been doing this. And we've been through all types of gyrations. But what I teach on the webinars a lot is this, because people like pattern trading. It's easy to see, visualize, and act on. And it also teaches you good habits and good disciplines that you would use in any other style of trading. And, so what you want to be able to do is find rationale, reasons for being in a trade, and technical analysis is one of the things that people find fairly simplistic to track. This model has been, I've traded this model for, it's not even a model, it's a strategy. But I've traded this strategy for probably 14, maybe 15 years. It's gotten better and better over time. And, it continues to get better over time. And because I get better at practicing it. And so here's, to me, I'm going to pull this over because I forgot to open the web page. Here is right here in the middle. This is what it's based on. Pattern trades are, based on this is that we took $100,000 and we put 5% or $5,000 into each position. If it states to take a half a position, you only take half or 2.5% of the position. But each trade is managed, with 5%. So if I got 100,000, each trade is $5,000. And all I'm doing is trading that $5,000 based on a distinct discipline for pattern trading, which is what we just talked about, which is getting in, setting a stop, and going along. And if we look back at the historical trades, you can see that there are trades that make double-digit returns. I mean, the short on oil is, I'm going to say that that's 90% luck. It should have been a 10% profit, but because oil decided to fall out of bed, not because of anything we saw it falling out of bed to $40, $45 a barrel, but we saw it falling to $70 to $75 a barrel, which was the short trade. It actually became a great trade. But you can see other trades that lose. I mean, you can see 1%, 3%, 4%, 5%, some are 7%. The bigger losses within here are gap downs that take the stops out during the day. So we have to. That's what we've traded for the current calendar or current strategy year, and then all of last year's trades, which you can see they get dinged every now and then. You're going to get a gap loss. I'm just looking for where we hit the gaps. You can see 345. You can see 2, 2, 2, 2, and they come in bunches. You can see from here to right in here. You can see that there's more losses than gains, and that's where you get into a choppy market environment. You got to trade through them, or you're not going to be true to what you're doing. So what I want to do is for $250 for the month of February, which, by the way, in January, that model on $100,000 made $2,885. So if you took it back to the December, it was up $5,200 in December on $100,000. So it works. It's probably had a negative month somewhere. I don't really focus on those because I don't like bad news. But if you want to do this, you got to send me an email. You can send it to jim@jimsnotes.com. But what I need from you is an outline of why you want to be a part of this program and what you want to learn from me during the month of February relative to this. Define your greatest challenge in managing your money, what you believe to be the root of the problem, fear, emotions, overall, discipline, strategies, etc. Do you find yourself flipping in and out of strategies? Do you change your strategy after you buy? Are you a raging neurotic? Do you currently define entry, exit, and targets based on the defined strategy in your current discipline? In other words, some people are just buying and they're just kind of going along and they decide where to exit based on what happens that day. That's not a strategy. That's a seat of your pants. You may have had an entry strategy, but the rest of it has to be defined. Define how you use them briefly and your commitment to the 1 month process. How committed are you to learning how to do this? I'm not going to coach you. I'm not going to sit over your shoulder, but I will help every day produce what looks like this, because this is what I do for myself. In that, this is my trade list for today. This is my pattern trade list for today. And this is the setups that what we're looking at, whether or not we need to adjust, what we need to do, don't do, or not do anywhere along the way. So I'll send you the email in the morning, and then once a week we'll have a webinar like this, but you'll log in. You'll be able to communicate with me on GoToMeeting. We actually have a service there that we can log in up to 25 people and have a meeting. So this is going to be limited to 25 people, obviously. If 5 of you sign up, then we'll still do it for 5 of you. If 2 of you sign up, we'll do it for 2 of you. But I don't really care. I'm trying to figure out whether or not people are teachable, hard-headed, whether you're your own worst enemy, or whether you just need tweaking in what you're trying to trade. But once every week on a Monday, we'll log in for an hour, and we'll go through some of what we're looking at for the week, some of the problems that you're having, and how to kind of correct some of those things, but have an open forum relative to that. I'm all about teaching. I hate the word coaching. Coaching is a crutch. Coaches walk along beside you and tell you when to step, sneeze, or fart. I'm not into that. That's not my personality. I don't do well at it. I am a phenomenal teacher to people that want to learn. But you've got to practice, and you got to go and practice with it to get to where you want to go. So if you want to do that, you need to send me an email, Jim@JimsNotes. If you didn't have time to write all that down, I'll shoot you an email back with the questions on it that I want you to answer. And I'm sure my brother will put together some stuff that we'll post over the website over the next couple of days. And if you email me between now and Wednesday night, Thursday and Friday, I will send you, to everybody on the webinar, I'll send you these notes if you want them, but you got to email me that you want them. I'm not just going to, I hate bugging people. I don't beg anybody. I have nothing to win, lose, or draw by this. I can sit here, manage my own money, and be perfectly content. I teach because it's my nature. It's my brain that makes me do this. but I want you to learn. I'm not here to tell you what to do or how to do it. I'm here to teach you to figure out who you are as a trader. So I wanted to offer that tonight. So for February, if you'd like to take advantage of it, then jump in. We'll have longer programs as we go forward in the year, but I'm ready to start seeing if people really want to learn how to trade or not, and see how this progresses from here. So with that, you got my email. You got the webinar. You got a lot to chew on tonight. If you need to get a copy of the webinar, Don knows how you can get a hold of that. You can email him, Don at jimsnotes.com. Email me the response to this offer to Jim at jimsnotes.com. Have a great evening, and we'll see you soon.